Let's take a look at your market news now. Asian shares edged cautiously higher today as investors try to shake off worries about the coronavirus epidemic after a slight decline in the number of new cases. China, the world's second largest economy, is still struggling to get its manufacturing sector back online after imposing severe travel restrictions to try and contain the virus. The People's Bank of China cut the interest rate on its medium-term lending on Monday, which is expected to pave the way for a reduction in the country's benchmark loan prime rate on Thursday, as policymakers try to ease financial strains caused by the virus. The Japanese Nikkei picked up 0.9% today, closing the day out at 23,400 points. The Hang Seng was also a big climber, taking in 0.6% to end the day off at 27,674 points, while the Shanghai Composite Index was the only loser this morning, drawing down 0.33% to 2,975. Let's go to Wall Street now, where the Dow Jones and the S&P 500 fell last night, while the Nasdaq ended just above the unchanged mark as a sales warning from the tech bellwether Apple highlighted the impact of the coronavirus outbreak on global supply chains. The Dow Jones Industrial Average fell over 0.5% to 29,232 points, with the S&P 500 losing 0.3% to 3,370 points, and the Nasdaq Composite was mostly flat at 9,732 points. Let's go to Arabile Gumede, who's standing by with some more market news. Arabile, you're done hobnobbing with CEOs. Now it's time to get a look at the market picture.
Nzinga, of course, the market here is sitting in green territory then this afternoon, 0.2%. Earlier on, I got to chat, of course, to the CEO of Sibanye-Stillwater, Neil Froneman, who certainly has revolutionized that company. I said to him, indeed, that it was a company that really just took what was assets that were discarded almost from Goldfields when Nick Holland was CEO then, not wanting those assets, and now he's basically turned them around and created value 12 times greater than what they were at the time. They're now one of the 20 biggest companies in South Africa, so meaning that the top 40, they're in the top half of that now. So certainly that company has done really, really well and continues to not just go into the gold space, but really diversify things. Stillwater, of course, was a big play for them out in the United States. They took over DRD Gold. The Lonmin assets were, of course, the big ones where they look to diversify their business as well. So things are certainly teaming up. The question becomes, how far can you run this road? And when does the buck stop, I suppose, then, for Neil Froneman? Overall, though, let's go into the international news front. Well, the coronavirus or COVID-19 still certainly impacting market movement and how things are faring there. Shanghai dipping down today as well. Perhaps investors not as excited as to see how things are faring on that front with regards to trying to contain the virus as well then. And as you said, you do have the likes of Apple, unfortunately, and that review. Samsung does come out on top in that regard then, because half of Samsung's production is actually out in Vietnam, which has had little to no impact from the coronavirus or COVID-19. So they're certainly reaping the rewards of what has been a 10-year bet that they could get this scenario right. And of course, HSBC cutting 35,000 jobs across Europe, specifically to focus on markets in Asia. So some big news really impacting the markets. Let's see how exactly it's impacted those numbers, and we'll get into the details right after this. So a slightly positive picture when it comes to South Africa's JSE there, as you can tell then. And of course, the big story will be about Sibanye-Stillwater. But we also have some other news. Grand Parade Investments has decided to divest then and perhaps discard its investment as well in Burger King, which it brought to South Africa in 2012 to much fanfare. And they're doing away with it now for 670 million rand, 92 restaurants across the country that hope to ramp that up to 135 about 3 years ago. That is not going to happen anymore. Let's chat about this and a whole lot more now. Makwe Masilela from Makwe Fund Managers joins us here at the Johannesburg Stock Exchange. Makwe, thank you so much for the time.
Pleasure.
I suppose we'll kick off first, though, with sentiments from Neil Froneman, the CEO of Sibanye-Stillwater. You heard his sentiments. What do you make of that business?
The guy's done well, and for the fact that from the word go, they said they want to be a diversified mining company. I think we should expect more going forward. We know gold is
more acquisitions, you reckon?
Exactly. Gold now accounts for 15%, and we expect that to increase to almost 40%. And the guys will definitely look at the likes of the lithium, the likes of cobalt, nickel, because they said they want to be a diversified company, and we expect them, as they said, that to start resuming paying dividends. But as you said earlier, they've done well, and so far for them as well to reduce their net debt to EBITDA to almost 1.25. I think that's excellent. Remember, that's within the confidence that has been set when they were buying that Stillwater for almost 30 billion rands.
Yeah, you would make note last night was Glencore's earnings, and they came out really saying that they've hit a loss for the first time in 4 years. And if we remember the metals that they're sort of in charge of or responsible for, trying to diversify in the case of Sibanye-Stillwater to those kind of metals, is this the kind of time where they should do it? Because, you know, much like gold and platinum, they invested when things were down and then hopefully they'll pick up later. Or is it perhaps a dangerous play in a nervous market?
I think the price will be right for the fact that those commodity prices, I mean, they've been weakened. They'll be able to get them for a song, unlike buying them at a high price, like the likes of Anglo-American have done at some point. So I think this will be the right time for them to be able to do that. And for the fact that if they could be able to push their net debt, you know, to EBITDA to almost 1, then the guys will still be in a good position to be able to make those acquisitions. But is it the right time? I think it is, and they'll be well positioned in case, and we're all hopeful that the economic world will one day turn around and the guys will be well positioned.
Yeah, we'll certainly see how things fare. Look, it's certainly a remarkable story to have continued to push things along. In other equity news, Grand Parade Investments doing away with Burger King. Not surprising, really, is it?
Not at all. Remember, last year, June, they did away with their 10% in Spare. And then in February, last year as well, they did away with those other franchises. You are Baskin, you are Dunkin as well, Dunkin because they were not doing well at well. But remember, the guys is an investment holding company. So when you value at them, you look at their intrinsic net asset value. And it has been trading at a huge discount, and mainly because of those food and manufacturing activities, since they're doing away with that. And they will kind of be more focused when it comes to their gaming, you know, where they're minority holders. I mean, they are involved in casinos, they're involved in sun slots. So hopefully, the minute they continue getting out of this food thing, it will help their discount when it comes to their net asset value, and probably they will start trading much better. But it's something that has been expected.
Was it really a bad decision to get into the food elements? I mean, at the time, I remember even the likes of famous brands had gone right into things like Wakaberry, right? And then, of course, on the American brand side, you had these brands like Burger King coming to South Africa. Was it a bad play at the time, or did they just perhaps misread the market?
I think it was not bad because they got involved in the right franchises. I mean, everyone was keen to buy Burger King, but unfortunately, they undermined the setup cost and it became too expensive. The same story we can tell about Taste and Starbucks, that the setup cost becomes so high. So yes, are they good franchises? Yes, they are. Hence, other people are buying them. And it's a question of, will you be able to set them up much cheaper? Then hopefully, if you're able to do that, then I think it's a win, because people still like those franchises going forward.
Yeah, definitely. All right, let's take a look at inflation then as well, which has come out today. 4.5%. It's the first time it's pretty much hit that midpoint of the target range for at least about 3-4 months or so. It's the first, it hasn't actually gone past 6% since, I think it's early 2018 as well then. So the question becomes, even if it hits 4.5% as it did in January, does that perhaps create a sense of fear for the Reserve Bank that things are spiking up a little bit too much and we need to rein things in a little bit?
I think to some extent, remember they're happy with inflation expectations being around 4.5.
Yeah.
And when we were hovering around 4%, that was excellent for them. And they said it themselves that they expect inflation to average almost 4.7 for this year. But the problem is that things they're totally out of their control. Should the rand continue to weaken because people have got issues with emerging markets, or because the dollar itself is strengthening, then unfortunately it's going to affect inflation because we are a net importer. So I think we are better off when we are playing around the 4.1. But yes, 4.5. Will they increase interest rates in the next meeting? Definitely not. But because they themselves have already baked in 4.7 for the whole year. But I think it should be better if we go back to the likes of 4.2 or so. And for obvious reasons, it was oil going up as well. Petrol prices, if you compare it to January last year, they've gone up by almost 15%. Your household and utilities, they've also contributed almost 1.2% to the increase of inflation.
Yeah, so if you take a look at the Brent crude price, which I sometimes use as a barometer to really see how people are sort of feeling about the economic circumstances, I suppose, across the globe, now up 1.33%, $58.55 a barrel. Of course, you had OPEC saying that they're going to drop down in terms of production as well. Do you think that's beginning to take effect in this market?
Not really, because I think OPEC itself, they've been, they took time to act, and they didn't even have that emergency meeting. I think they'll only be meeting next week, and hence we see oil prices going up. But for the fact that we expect the world economies to start stimulating the economies, China have started doing that. Even on Monday as well, they reduced interest rates. Hopefully, maybe we'll start seeing the world economy starting to pick up. And should that happen, then demand of oil will be back into play. And that definitely might be an issue. But OPEC, we hope, yes, December, they did increase the cut by almost 500. So now they're sitting at a cut of almost 1.7 million barrels per day. So the next meeting, and we know Russia is very reluctant, so I think it's a question of wait and see. But oil prices will continue to be a big play into this whole thing.
Yeah, just under $59 a barrel, Makwe. Appreciate the time. Thank you so much for that. Makwe Masilela there is from Makwe Fund Managers, helping us unpack that market picture a whole lot more here at the Johannesburg Stock Exchange. From me, though, that is where the buck stops. We still have a slightly positive market for today. Whether that will continue to be the case, we'll certainly find out a little bit later. But my colleague Nzinga Qunta joining you right after the short break. Stay tuned. This is SABC News.